Hi guys, it's Chris here again. Just a little video on trading breakouts on the retest. So I'll go through a couple of examples of what I'm talking about here. So basically when you've got a trend line or a support and resistance line that all of a sudden gets broken, it's not always advisable just to suddenly enter that trade just for the sake of that level being broken. It's more diligent to actually wait for the market to pull back again before entering the trade in the direction. So I'll kind of go through what I'm talking about here. So obviously this is the daily chart. It's the pounds, US dollar. We've all of a sudden had this trend line. It's hit on 1, 2, 3 places, and then you've had a bearish candle break through that trend line there. We go down to the 4-hour. Zoom in a little bit, and yeah, that's the start of the trend line. It's hit that point, and then all of a sudden it's basically it's come down, and there's a significant bearish candlestick which has broken through that trend line. So one option is obviously to enter a trade at the close of that candle, but a better option is to actually go down to a smaller time frame. We just highlight that section there so we can see where I'm talking about. We go down to the 1-hour chart. Okay, so we've gone down to the 1-hour chart, and we can see that the price has broken through there. And then here's our ABC setup. Basically, we do the normal thing. We do our Fibonacci from A to B. And then we have basically our zone. We can see that the market has turned on this 61.8 level here. Stochastic has gone into the overbought section and come down. And basically we can enter the trade on the retrace rather than just entering in on the break of that daily trend line. If we go as well, okay, so sometimes you'll see as well on a sort of horizontal level, a support and resistance. You've had this big candlestick which is significantly closed underneath this support and resistance here. So one choice is, yes, we could enter on the close of that candle and trade down. Another thing that we could do, again, is we could, once we've had that close of that candle, let's just look at what that looks like on the smaller time frame. Okay, so there was the break, and then we've had this candle come down here. Now the problem is, if you'd have entered on this candlestick on a sell, then all of a sudden the market comes back up. So it's better off. You're better off to actually just wait for these retracements to happen on the smaller time frames before plowing in there. You've got your A to B happening there, and then yeah, market comes up to our 50 Fibonacci and a nice couple of tweezer tops there, Bollinger Bands. Stochastic signals, and we could have entered that trade down here. We've gone on the close of the candle, stop loss, and we can trade that down there. Then it gives you a nice 1.8, depending on how near your stop loss is. So yeah, that's really all for today. Again, you just, once you see those big bearish candlesticks or those candlesticks close significantly past the level, don't just jump into the trades. Pop down to the smaller time frames, see if you can see any retracement, or look for the next retracement to get you the entry in. Give me a shout, let me know if you've got any questions on that or anything else. I'm on the chat room the whole day. You guys can phone me, email me, send me smoke signals and bird mail and anything else you want to do. All right.